Good morning, Jen Tozser, your portfolio manager here. And although this isn't about the stock market, I have a lot of clients who've been asking me, what do I do now that my mortgage or my kid's mortgage is coming up for renewal? Because when they signed up, rates were basically 3% or less, and today they're almost double. So here's a comment. Mortgage rates today, when you look at them, are a little bit confusing, because a one-year rate is about 6.4% and a 5-year rate is currently 5.15. Usually, a one-year rate would be lower than a 5-year rate. Right now, it's the opposite. And a variable rate, which traditionally has been the lowest rate out there, is basically prime minus a half, and that's 6.95 minus a half a percent, so 6.4, the same as the one-year rate. So what do? What I'm going to tell you is you're going to look for the inflection point in the curve. You have to have an opinion on where interest rates are going to go, and my opinion is that we're very close to the top of the market. And that's consistent with what we see being offered by banks and what we would call the term structure of the mortgage rates. Since we're getting close to the top, pick something that's not going to give you the most stress. When you're young, fixed rates are generally better than variable rates because you need some consistency with your obligations and your income's likely going to rise. When you're towards the end of your mortgage, you've got more flexibility in accepting market risk because your mortgage represents a smaller portion of your monthly obligations. Now, the next question I've been getting is, what do? I could really afford my mortgage easily at 3%, but now that it's going to be at 5.5, or at 5 if I'm super lucky, what does that mean for my payments? Should I put capital on it? What I do for my clients or their family members or my friends is I take a look and I see how much is going to interest, and we actually do an analysis of what the impact of adding capital is to your mortgage. And I like to say that I don't like it, and people are going to have this scenario where if they had originally signed up for a 25-year amortization and a variable, they're renewing, and they're now all of a sudden on a 30-year amortization. You need to put some capital down if you can. So you need to do, or have someone help you, do an analysis of what the relationship is between the excess capital, your current payment, your future payment, and your final amortization. I know that sounds like a lot, but a lot has changed. If you have any other questions, please give us a call.